The United States is an energy powerhouse. It holds the title of top oil producer globally. In recent years, the U.S. has achieved record-breaking oil production levels. Yet a curious situation persists. The U.S. also imports a significant amount of oil. This seeming contradiction often sparks questions and confusion. Why would a nation so abundant in oil resources rely on imports? The answer, as with many things in the energy world, is complex and multifaceted. It's not as simple as just producing all the oil we need. A web of factors influences the U.S.'s decision to import oil, even when domestic production is high. These factors range from the specific chemical properties of different oil types to the intricate network of global trade and geopolitical relationships. Understanding this paradox requires delving into the intricacies of oil production, refining, economics, and geopolitics. In the following sections, we'll unravel this complex issue. We'll explore the science behind different types of crude oil and the specialized processes involved in refining them. We'll examine the economic forces that make importing oil a financially sound decision in some cases. We'll also analyze the geopolitical considerations that factor into the equation. By the end, you'll have a clearer picture of why the U.S., despite being a leading oil producer, continues to import oil. This exploration will shed light on the delicate balancing act the U.S. maintains in navigating the global energy landscape. To understand the dynamics of oil imports, one must first grasp the inherent diversity of crude oil itself. Crude oil, far from being a uniform substance, exists in a variety of forms. These variations are categorized based on two key characteristics: weight and sulfur content. The weight of crude oil, classified as either light or heavy, refers to its density and viscosity. Lighter crudes flow more easily than their heavier counterparts. The sulfur content, categorized as sweet or sour, indicates the amount of sulfur present in the oil. Sweet crude contains lower levels of sulfur, making it more desirable due to its cleaner burning properties. The type of crude oil a refinery can process depends on its design and technological capabilities. U.S. refineries, known for their sophistication, are typically configured to handle a mixture of crude types. Interestingly, many U.S. refineries are optimized to process heavier, sourer crudes. These types of crude, often sourced from countries like Canada and Venezuela, are generally cheaper than the lighter, sweeter crude oil produced domestically. This cost advantage makes importing these heavier crudes economically attractive. However, adapting existing refineries to process different types of crude oil is a complex and expensive undertaking. It requires significant investment and time to retrofit the facilities. For instance, the Shell Deer Park refinery in Texas is specifically designed to handle heavy Mayan crude from Mexico. Switching to a lighter crude type would necessitate costly modifications to the refinery's infrastructure. Beyond the science of oil refining, economic considerations play a crucial role in the U.S.'s decision to import oil. One key factor is the price differential between domestic and imported crude. While the U.S. produces a substantial amount of oil, it's not always the most cost-effective option. Transportation costs, production costs in different regions, and fluctuations in the global oil market all contribute to price variations. Sometimes imported oil, even with transportation costs factored in, can be cheaper than domestically produced oil. This difference arises from lower production costs in certain countries, making imports an economically sound choice for some refiners. Another economic driver is the existing refinery infrastructure in the U.S. As mentioned earlier, many U.S. refineries are equipped to process heavier, sourer crudes. These refineries have made significant investments in infrastructure tailored to these specific types of oil. Shifting to lighter, sweeter crude would require costly overhauls, making it more cost-effective to continue utilizing the existing infrastructure for heavier crudes. Furthermore, the global nature of the oil market influences import decisions. Oil prices and supply chains are interconnected on a global scale. The U.S., as a major player in this market, engages in both imports and exports as part of a complex balancing act. For instance, in 2020, despite high domestic production, the U.S. imported significant amounts of oil because overseas oil was cheaper due to lower lifting costs and a drop in global demand. Beyond economics, geopolitical reasons for oil imports. While economics play a significant role, the decision to import oil extends beyond dollars and cents. Geopolitical considerations also factor into the equation. One primary reason is energy security. By diversifying its sources of oil imports, the U.S. enhances its energy security. Relying too heavily on any single country for oil imports could leave the U.S. vulnerable to disruptions caused by political instability, conflicts, or natural disasters. Importing oil from various countries mitigates this risk by reducing dependence on any one source. This strategy ensures a more stable and secure energy supply for the nation. Another geopolitical aspect is the role of oil in international trade relationships. Oil imports and exports are not merely transactions, they are often intertwined with broader diplomatic and economic ties. For example, the U.S. imports oil from Canada, Mexico, Saudi Arabia, and Iraq, among other nations. These imports are part of a complex web of trade agreements and partnerships that extend beyond energy. Maintaining these oil trade relationships can strengthen diplomatic bonds, foster economic cooperation, and promote stability in key regions. The shale revolution and beyond, future trends in U.S. oil. The U.S. oil landscape is in a state of constant evolution. The shale revolution, which began in the late 2000s, unleashed a surge in U.S. oil production. Technological advancements, particularly in hydraulic fracturing and horizontal drilling, unlocked vast reserves of shale oil and gas that were previously inaccessible. This boom in domestic production led some to believe that the U.S. might achieve complete energy independence, ending its reliance on oil imports. However, the reality is more nuanced. While the shale revolution significantly boosted U.S. oil production, it didn't eliminate the need for imports. Several factors contribute to this continued reliance on imports. First, as discussed earlier, the type of crude oil produced domestically doesn't always align with the refining capabilities of existing U.S. refineries. Second, global oil markets are interconnected and price fluctuations can make imports economically advantageous at times. Looking ahead, several trends will shape the future of U.S. oil production and imports. The growth of domestic production, particularly from shale formations, is expected to continue, though perhaps at a slower pace than the initial boom years. Technological advancements and efficiency improvements in extraction techniques will likely drive further growth in shale oil production.